delivering the world to your doorstep. From breaking news to in-depth features, from politics to culture, from science to sports. Welcome to SNN Primetime News with Kennedy Lucas Patterson.
Good morning, Atlanta. This is SNN by K.L.P. Entertainment. Here's the headline at the top of this hour. Mortgage rates shot higher Friday after a monthly government report on wholesale prices showed inflation is still persistent and hotter than most analysts had expected. The average rate on the 30-year fixed mortgage jumped to 7.14%, according to Mortgage News Daily. That is the highest level in 2 months. Mortgage rates hit their last high in October, but then fell sharply over the next 2 months, leveling out at around 6.6% in December. They climbed back over 7% last Friday after another government report on consumer prices came in higher than expected. There are 2 ways to look at recent rate trends in light of the data-driven spikes over the past 2 weeks, said Matthew Graham, Chief Operating Officer at Mortgage News Daily. On one hand, we can take solace in the fact that rates are still almost 1% lower than they were in October. On the other, the optimism for lower rates in 2024 has abruptly given way to skepticism. The drop in rates at the end of last year had caused optimism in the housing market as higher interest rates, coupled with high home prices, sidelined buyers in the fall. Sales of newly built homes soared 8% in December, according to the U.S. Census Bureau, with lower rates acting as the primary driver. Homebuilder sentiment, based on an index from the National Association of Home Builders, has been rising for the past 3 months as builders reported that lower interest rates were driving buyer traffic to their model homes. In February's report, builders said they expected mortgage rates to continue to moderate in the coming months. Buyer traffic is improving as even small declines in interest rates will produce a disproportionate positive response among likely home purchases, said NAHB Chairman Alicia Huey, a home builder and developer from Birmingham, Alabama. And while mortgage rates still remain too high for many prospective buyers, we anticipate that due to pent-up demand, many more buyers will enter the marketplace if mortgage rates continue to decline this year. Demand has been strong, despite high home prices and very low supply of homes for sale. Adding to that, President's Day weekend is considered to be the unofficial start of the all-important spring housing market. But this new upswing in rates could drive buyers away. In January, when rates flattened from their declines, both signed contracts on existing homes and new listings weakened, according to Redfin, a national real estate brokerage.
Institutional investors are trimming their alternative investments such as hedge funds and private equity. Family offices are pouring even more money into the sector, according to a new study. KKR's Family Office survey of 75 chief investment officers around the world found that family offices had 52% of their portfolios invested in alternative investments in 2023, up from 42% in 2022. The growth in alternatives is coming at the expense of almost every other asset class, as their cash holdings fell from 11% to 9% from 2022 to 2023, and their holdings of publicly traded stocks fell from 32% to 29%. The moves are part of a broad shift for family offices, the private investment vehicles for wealthy families, as they move away from public markets toward privates and alternatives, everything from real estate and private equity to direct stakes or ownership in private companies. Since family offices have longer time horizons than other investors, preferring assets that will grow over multiple generations, they can invest in private business and alternatives that pay a premium for more patient capital. Family offices also have a special advantage in the current market, since banks and more traditional lenders are pulling back on loans to companies. Many large institutional investors are shying away from private equity, venture capital, and other asset classes that have suffered from a lack of initial public offerings and acquisitions. Family offices plan to continue to move capital from cash and stocks into alternatives this year, according to the survey. Fully 42% plan to shrink their holdings of cash, and 31% plan to trim equities. Their favorite alternatives include private credit, with 45% planning to add to their holdings, followed by infrastructure, 31%, private equity, 28%, and commodities, 18%. Many are also planning to put more of their money to work in real estate, though only in specific sectors. The report said family offices are concentrating on data centers, logistics and warehouses that capture the important post-pandemic investment themes. Another sector family offices like right now, oil and gas, in both private and public markets. That's your news at the top of the morning hour. This